On the 2nd of March 2026, Brewdog went into administration. This business that was once valued at £1.8 billion was sold for $33 million to a US company, with large parts of the business, mostly its bars, being closed. 38 bars and 484 jobs were put immediately at risk, with more potentially to follow. In this video, we're going to take a look at the latest filed set of Brewdog accounts and ask the questions. Did these accounts show the risk of Brewdog's failure? Where it uses the going concern note, was that appropriate? And was the auditor's report and their opinion appropriate as well? So first of all, what is the going concern note? The going concern note is the basis on which you prepare the accounts if you think it can continue for another year. If it can, then you value things fairly reasonably, but if it cannot, then you're looking at valuing things on a breakup basis and potentially at fire sale prices. There's therefore a big difference between the two, and using the wrong basis can make the accounts look quite a bit rosier. Within the accounts, we have the strategic report, which certainly in places demonstrates some of the issues that were being faced. You've got a loss of 35 million for the year, down from a loss of 60 million the year before. Over the 5 years up until this, Brewdog had lost about 150 million in total. They highlight that there is a liquidity risk, albeit the way of mitigating this does not sound too dissimilar to what a lot of companies would put into their report. On the director's report, we talk specifically about the going concern, and here the future looks more rosy. It is worth noting that this is narrative from the directors and therefore can appear a bit more optimistic than maybe should be the case, but they talk about here the additional funds that were being given by TSG, the private equity part owner of the Brewdog business, the level of testing they have done to make sure that the going concern basis is reasonable, and steps they are taking to make the business more sustainable for the future, including closing down 10 bars where profits were not being made. While the narrative can be pumped up to some extent, it can be harder to hide in the numbers. And where we see the profit and loss for the year, we see some bad signs in some different places. We've got stagnating growth with only 3 million of additional revenues year on year. This is a period of high inflation and we're only seeing a 1% growth. And this could well actually be a decline in underlying business, but with higher prices. We're then seeing an operating loss. So this is before finance costs and is a good indicator of whether the underlying business is sustainable. Again, the previous year's loss of 45 was bigger than the current year of 20 million, but that's not a sustainable number. We then have finance costs that are growing year on year, 13 million in the prior year, 17 million in the current year. The only good thing that you can say is that these losses have gone down from 64 million to 35, but that's not a sustainable position to be in. Looking at the balance sheet, we can see that actually that 30 million loss is approximately 2 years worth of the net assets that we've got at the end of the year. That is an improvement on the previous year, where the 65 million loss versus the 93 net assets would only have given a year and a half before net assets hit zero. That's not a good indicator though of company strength, as a company of this size does need net assets significantly above zero in order to continue to operate. We do see some bad signs here as well though, with financial liabilities increasing, the short-term under 1 year part rising from 24 million up to 35, and the longer-term financial liabilities increasing from under 70 to over 80. Both of these are indicative that the company is taking on more debt, and again, if it's stagnating in terms of growth and it's not showing profits, that's a dangerous position to be in. Looking at the equity part of the balance sheet, we can see that the retained earnings, so to speak, are actually 126 million of losses. This is the net result of that 150 million of losses over the 5 years. Arguably, where there were some profits in the past, these have been spent and were used to cover these losses. And additionally, where 183 million of equity had been sought from various sources. This has been nearly burnt through by this point, with only a third of this remaining. In terms of the going concern appropriateness, there are 2 years of funds left, but that becomes very tight at some point. As well as the profit and loss and balance sheet, we do have the cash flow statement. There are some notes on here. So overall, we're seeing a 2 million decrease in the overall cash, and that is despite raising 19 million of new loan notes during the year and of slashing investment in property and plant by nearly 2/3. Another piece to note is that you've got net cash flow from operating activities of 6 million, and that is despite a 30 million loss in the year. So the obvious question is, how does that 30 million come from lead into a 6 million positive cash flow? And the answer there is it kind of does, but there's some worrying signs here as well. One good thing on this is you've got 18 million of depreciation. Now this is a non-cash expense, so it does go some way to bridging that gap. But you've got finance charges of 17 million, and you've got interest paid of 10 million. Now the difference between those two is 7 million. So there's part of me is looking at this and saying, you made 6 million of cash because you didn't pay 7 million of interest charges that accrued. So realistically, I think this should be 0, and it only looks like a good number because they're playing the numbers a little bit, and it's showing a slow degradation, similar to what the balance sheet position did. We're going to skip over a good number of the financial notes now. You can look at these on Companies House. They're free to look at, and you've got things like the stock note, the debtors note, which aren't particularly interested in terms of the longevity of the business and the reasons for its decline. We're going to skip to note 21, the financial liabilities. We see here various liabilities that are being described. Of note in particular, you've got bank overdrafts that have gone from 10 million to up to nearly 24. This is a pretty big movement year on year. It is worth noting that the cash reserves have also increased. They went up from about 20 million to 30 million, and yes, there is a question as to why do they have cash and bank overdrafts. And the answer here is probably because there are so many companies in the group. Some will have cash and some will have overdrafts on any given day. Because of the number of companies, it's probably not efficient to continually move money around so that you're netting the two off against each other. But that is an unnecessary expense to maintain the interest payments on that to a certain degree. You've also got loan notes that have doubled in the year, going from 17 million up to nearly 42 million. And we're going to see more of those in just a second. You've got a number of other loans there, much smaller, a 1.8 million pound loan, a 2 million loan, a 5 million loan, and even a 25 million loan. Most of these numbers look much smaller when we're looking at the actual liabilities, because most of these have been paid off in instalment and are nearing the end of their life. So these are not as interesting in some respects, but another store of bad news to come. Where we're looking at some of the detail on these loans, which again is in these accounts on note 21, we can see that the interest rates on a lot of these are fairly reasonable. From my experience with some large businesses, 1.4% plus base rate is very reasonable. 2.6% plus base rate even is fine. If you take this back to late October 21, when the Bank of England base rate was 0.1, this was 2.7, 1.5% to service this debt. You go forward by 2 years to after the Liz Truss premiership ended, and the Bank of England interest rates were 5.25%, meaning that potentially that overdraft suddenly is close to 8% to service. That's a big jump up, and is starting to be quite difficult to service if you're consistently having a good amount of debt outstanding. One negative to call out here is that the 25 million loan is repayable in a single instance in August 2026. So at some point that was going to need refinancing. And a good question would be, what was that going to be refinanced to? On the next page, we've got some details about some of the more recent financing that the company has done. These are generally loans with TSG, the private equity investor, and these are at an interest rate of 15 to 18%, which is significantly higher than the loans we saw on the previous page. Also, we know that these loans are much bigger. We saw that went from 70 million up to 40 million, and we can see down in the finance cost note that a good part of the year-on-year delta here is the loan note interest growing from 2 million to nearly 5 million. That would only get worse after the year end, as you have another 15 million that was drawn, with potentially that further 5 million of the total 20 million facility being drawn as well after the accounts have been signed off. This 15 to 18% is bad in another couple of ways as well. Number one, there should be cheaper finance out there than 15 to 18%, so this feels almost like it's a lender of last resort, and that probably doesn't bode well for when that 25 million was going to come due, or if any additional finance was going to be needed. We've seen that the company was making losses, that it was cash flow negative, so additional finance would be needed at some point. Additionally, even fairly profitable companies, a 15 to 18% weighted average cost of capital is a difficult amount to service, whether that is interest or equity. Let's say that the company made 12.5% return on all of its net assets. Well, if it's paying 15 to 18% in loan note, and most of its balance sheet is taken up by debt rather than equity, and that's pretty worrying, and indicates that you're going to be in a doom loop where the interest gets bigger, which means that you need more financing, which means that the interest gets bigger. Without underlying growth of the business, and importantly, profit, then that becomes unsustainable in even the medium term. Note 22 talks about capital management. This was one of the notes that I think was cited in the going concern note. There's a few things of note here. Number one, that there's more than 370 million of debt at the year end. Also, because the assets have shrunk from 93 million down to 60 million, both the lower assets and the higher debt are pushing that gearing ratio higher. It's gone from 79% in the prior year to 85% this year. When you factor in that after the year end, losses will continue to be made, and there's an extra 15 million of debt that was issued, that's going to go even higher. The gearing ratio is a measure of risk in relation to the amount of debt. A higher ratio means a lower capital investment is needed, but also it means that company is more susceptible to interest rate shocks and to downturns in business becoming catastrophic. Considering this company was loss-making for a number of years, that feels like a problem. Before we go back and answer the three questions we asked at the start, I think it is worth talking just quickly about the employees of the business. It's worth remembering there were 2,500 people employed by the business at the end of the 2024 financial and calendar year. We know that after the year end, 10 bars were closed down, which would have had job losses. We know that from the 2nd of March going into administration, 484 more jobs were expected to be lost, with 38 bars being closed. And there were potentially further job losses on the table. Plus, who knows what this business looks like in 2 years? Does it continue even after being bought for 33 million? Potentially, but there's a lot of uncertainty for a lot of remaining employees. The questions to answer them. Number one, did the account show the risk of Brewdog's failure? Number two, was the going concern note appropriate? And number three, was the auditor's report appropriate? For answer number one, was the risk of failure apparent? I think the answer there is yes. We can see that there was stagnant growth. The turnover was not going up year on year. There were mounting losses. Yes, the loss this year was smaller than the prior year, but cumulatively they keep on adding up. We had underperforming assets, so the 10 bars that were closed down, there's an argument that is cutting the dead wood to make the rest of the business more sustainable, but it turns out a lot of the bars look to be in a similar position. We have the depleted reserves from years of losses. We've got the increasing loans and debt year on year, and with more of that coming in after the year end. We've got the increasing interest costs because of the increasing debt, but because of the increasing interest rates as well. We've also got the balloon payments coming due in the short term. You therefore have problems with the total reserves, with the profit and loss, and with the cash flow. And those are all problems by themselves. Together, that's not going to go well for a business. In terms of the going concern note being appropriate, I need to say here, we have the benefit of hindsight, and where the directors were applying that going concern note, they are potentially a little more optimistic than they could be. But I would say that this was not appropriate, probably. The directors talk about them having a reasonable expectation, and it's not a yes or no answer, but they thought that the business could continue until 31st of December 2026. That was approximately 16 months away from when they signed the accounts and made that declaration, but they barely made it 6 months from that point, and a lot of those problems must have been known about at that point in time. They do talk about the extra facility that was given in terms of the 20 million from TSG, but 15 million of that had already been drawn down, so there was only limited additional resource, and we've seen that the balloon payment was coming due 5 months after the business entered administration. We don't know exactly what their tests for demand reduction or for plausible downsides looked like, but presumably it didn't include TSG withdrawing support, which must have happened for the business to need to go into administration, or at the very least, no additional support was given after that 20 million facility. Before we answer the question of the auditor's report, I think again we'll just talk a little about what the auditor's report means. Again, we have the benefit of hindsight. This was a decision that was made in late August based on information that was available at the time. And again, they're looking at a range of likelihoods and not a binary will this business survive or not scenario. That being said, they did make some comments specifically about the going concern basis, and this is a pretty fundamental point that they would have looked over. From my experience with auditors, they take this right up until the last day or two of the audit in terms of doing the work, to make sure they've got the best possible look at the future and to take into account all available information. The auditor's job, however, is to be more pessimistic and sceptical of the directors, who are potentially incentivized to be a little bit optimistic about the numbers. So in terms of whether it was appropriate or not, I'm going to run through my thinking before I give the answer. So the auditor here is not purely saying will the business survive or not. It's trying to talk about the accounts and whether they misstate anything. While the going concern note is a big part of that, it's not the be all and end all. Secondly, we don't know exactly what work went into this. There will be a lot of work, hundreds of hours by lots of people from both the auditors and within Brewdog itself to get these accounts ready, and we don't know exactly what that work looked like. There were, however, a lot of warning signs. The mounting losses and the tight balance sheet, the 20 million facility that was mostly drawn already, and the clear, obvious cash demands that were coming up in the future. While Ernst & Young would have looked at Brewdog's P&L forecasts and cash forecasts, we don't know what this work looked like, and we likely never will. The one thing I can think of that could be argued to mitigate this a little bit is that it's one of the major shareholders that probably triggered this move to administration, in that TSG probably didn't extend further loans. I can see someone making an argument that EY is making a report to TSG, but that's not quite accurate. EY is making a report to the shareholders as a body, and TSG is only one of those shareholders. In fact, it's not the majority shareholder. It had a 22% holding when it originally bought in. On the balance of probabilities, I'm going to go with we just don't know, but I think this report asks questions. Before signing off again, I think it is worth looking at some of the other stakeholders other than the equity holders in this company. The director's report calls out the way in which Brewdog is considerate of its customers, its people, and its punk equity investors. I think all three of these groups have been badly served as a result of this business going into administration. The customers will still be able to buy their beer because brewing appears to be continuing, but there's fewer avenues to buy it, as the Brewdog bars look like they're mostly being closed. In terms of the workers, there are hundreds of jobs that are still at risk. There are hundreds of jobs that have already been cut, and over the last few years, other jobs have already been shed. In terms of the equity for punks investors, as a result of this going into administration, they're taking a 100% haircut. All their equity is being wiped out. It's likely only TSG that will get any money back, and that's as a result of being the bondholder rather than the equity holder. If you enjoyed this video, then do like and subscribe. I suspect my next video will be passing this same analysis through an AI and seeing how that deals with it. So if you want to know how I rate Claude for analysing these accounts, I'll see you next time.